Well, hello, it's CMO, and today it's Panic on Wall Street Day. Welcome everyone to the Chief Mom Officer News Network, where we cover the latest breaking news on money, work, frugal family fun, and financial freedom. Today we're bringing you the hottest story of the market from last week, the inverted yield curve. You might think that the latest happenings in the market would make us upset, concerned, and nervous. But actually, we're excited because the more nervous you are, the more clicks and views we get. So to help us with that, I've brought in an expert-sounding white man in a suit from a research firm you've never heard of to help tell us why we should all panic now.
Thank you so much, Liz, for inviting me on. I never heard of the inverted yield curve before, but I Googled it and I saw a thread on Twitter about it, so I think I'm good to go.
Now that the yield curve has inverted, America has just one question. Should we all panic in the streets, or is this more a time we should be, say, hiding under our tables in fear?
Oh, no. This is much more a time to panic in the streets. We have the trade war with China. The stock market has been going up steadily for 10 years. Those three factors form our triad of doom, which signals that the market will crash at some point in the future.
Some point in the future. So you're saying recession is imminent and we all too shall die?
Well, actually it predicts recession sometime in the next few years. But my expert advice is to panic in the streets right now.
Thank you. And could you explain what an inverted yield curve is for our viewers?
Let me give an expert-sounding explanation I read on Twitter. Usually when you lock your money away for a longer time, you earn more money. So buying a 10-year treasury where your money is locked up for 10 years should earn you more than locking it away for 2 years in a 2-year treasury. This is a good thing as indicated by this research graph.
I see. So since the yield increases as duration increases, this forms a smile and therefore is a good thing.
What happened was you could buy 2-year treasury bonds that made more money than 10-year bonds. Since you should earn more money when you lock your money away for longer, the fact that you made less money by locking it away longer meant the yield curve inverted.
I see. So since as duration increased and yield actually decreased, this formed a frowny face and therefore must be a bad thing.
This means that usually a recession will follow sometime within the next 2 years.
And can you tell us when in the next 2 years to expect that recession, or should we all just panic now in preparation?
I would suggest panicking now. That way people will trade more, which makes us more money and gives you more views and clicks. It's a win-win for all of us. Well, for the two of us anyway.
Well, thank you so much, random white man in a suit from a research firm we've never heard of before. We at CMO News are grateful for your expert explanation of the inverted yield curve.
Thank you for having me on.
I know market ups and downs can be scary, especially when you're new to investing. You need to remember that investing should only be for the long term, never the short run. If you have money you need in the next few years, that money should not be in the market. Just look what happened between 2000 and 2010, where the S&P 500 had an average annualized return of negative 0.95%. I know the 24/7 news cycle and the instant access to your account balances wherever and whenever you want, along with the shared internet panic spreading like wildfire, can be scary. But I say if looking at your investment accounts and seeing them fall makes you nervous, I would highly recommend implementing my patent-pending ostrich strategy. This is where you simply don't look at your account balances for a while and instead go out and live your life and do fun things while the market does its usual gyrations. Play the long game, and remember, You have to be in it to win it. This is Liz from CMO News Network, signing off. Thanks so much for watching. I hope you enjoyed our new CMO News segment. In the description box below, I'll have a link to my not really patent pending ostrich strategy article that talks a little bit about essentially not looking at your account balances when the markets are going haywire and just giving it time as long as you're confident in your investment strategy. A huge shout out to my husband for playing the role of random white guy from a research firm you've never heard of, and my Twitter friends for contributing to the ticker messages that you saw throughout the video. I'd love if you would comment down below any other stories you'd like to see covered on the next episode of the CMO News Network. If you like this video, be sure to give it a thumbs up and subscribe for more content on money, work, frugal family fun, and financial freedom. Hope you have an amazing day.